This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and welcome to the SMSF Advisor Show. My name is Miranda Brownlee, and I'm joined by my co-host, Aaron Dunn, CEO of Smarter SMSF. Hi, Aaron.
Hi, Miranda. How are you?
I'm good. How are you?
Not too bad, thank you. Well, we have an election called now, so we sit and wait, don't we, to see what will transpire next.
Yes.
But as is always the way, our first part of the SMSF Advisor Show, we have a look at what's making news. So we'll get you to kick things off.
Yes. So as you said, the election's been called, so we'll see if advice or anything like that sort of comes up as a big policy topic. But in terms of news, we've seen the ATO focusing in a bit more on some of those independence issues to do with SMSF auditors. So that's to do with the independence guidance that came out a little while ago in terms of not being able to do in-house audits and that kind of thing.
Yeah, so this was interesting because it actually got a little bit of publicity around this. So insofar that there's been an increase in the level of contraventions that have been into the ATO, and the question is this: are we seeing more problems through COVID, or are we actually seeing potentially, with such a dramatic shift in the audits that were being completed in the industry, we're now seeing a much sharper focus on issues whereby they may not have previously. So it was quite an interesting one. As you said, the Assistant Commissioner, Justin McHale, did make some comment around the high risk auditor compliance work and around that compliance with the independent standards. And we did see some disqualification around or undertakings being entered into with a number of auditors with ASIC in recent times as well. So yeah, plenty of activity going on in this space, like I said, off the back of both the independence issues, but also with challenges that many funds would have had throughout COVID as well.
Yeah, and we've also seen some commentary from ASIC recently about auditors they've cracked down on to do with similar issues like that, particularly with independence. So, yeah, both sort of regulators are focused on that. The other small sort of development we saw was that merger between SISFA and Taxpayers Australia is going ahead. So the members did a vote on that and they've got sort of the go-ahead and, the merger will be going ahead.
Yeah, so that now will combine, obviously, two of those associations that previously had representation, I guess, SISFA in the small funds or SMSF space. Superannuation and Taxpayers Australia quite clearly also had an involvement within the SMSF sector. So, the coming together there obviously amplifies the message that they'll be able to have and obviously with their involvement in various stakeholder groups within the superannuation and SMSF industry as well.
We also saw a bit of regulatory action against larger organisations such as Macquarie and BT in the last couple of weeks. So the Macquarie one was to do with sort of a failure around detecting certain fraud that was happening through their systems. So that was to do with their advisor that was previously charged and sentenced for certain crimes, I guess you could say. And I think it's just an important reminder on the importance of sort of picking up or I guess protecting clients from fraud. Obviously, it's quite different for smaller firms, but that is still sort of an important thing that you need to keep in mind.
Yeah, so you've got that in financial services. We're also seeing the Tax Practitioners Board look at that for tax practitioners in terms of the requirements around or evidence that's needed to verify individuals as well. So we know as we move to a far more digitised economy that fraud detection stuff is going to become a bigger and bigger issue. And I know the ATO is going through challenges at the moment with fund establishments and the perception that there is obviously increase in fraudulent activity happening within there as well. So it's an unfortunate part of life in general now. And you can't kind of get away from this sort of activity happening, which is why it does place some significant importance on the roles that professionals have with SMSFs and superannuation more generally. Given the volumes of money that are involved, quite clearly there is going to be more and more interest of those willing to undertake fraudulent activities in this space because of the quantums of money as well. So, timely reminder. We have our regulators looking at it. We have increases in professionals needing to identify, who those clients are, and quite clearly where there are failures over this, the right sort of actions will be taken, as we've seen in that example that you spoke about before, Miranda.
Yeah, and we have seen a bit of a increase in SMSF fraud recently, according to what the ATO has been saying. Yeah. So it is important. The other big thing happening this week is the SMSF Association Conference, which you will be speaking at, Aaron.
Yes, absolutely. It's been 2 years, a bit over 2 years, because it was, of course, February 2020. The national conference was on the Gold Coast, and we're now back. I have to put some pants on to talk now rather than, just sort of see me from the waist up. It's all very different, but very much looking forward to it. And I think one of the great things about the national conference is just that sense of community that you do get with the, other SMSF professionals. Great diversity in speakers, not only from their technical knowledge, but also their background, whether it's legal or auditor or actuary or whatever it is. So, I'm really looking forward to getting my teeth stuck into it. Like I said, I have a presentation to do as well, so I do need to focus a little bit on that. But it's a wonderful conference. So if you are there, make sure you come and say good day to Miranda and or myself. And, just, really look at increasing your knowledge through conferences like this. Now that we're getting back out, I think there's a great opportunity for people to really get back and get engaged in discussion with your peers around the topics that are really shaping the SMSF industry.
I'm sure it's going to be a great event. And shortly we're going to be speaking to another one of the speakers at the conference, Graeme Colley, Executive Manager of SMSF Technical and Private Wealth at SuperConcepts. Graeme's going to be taking us through some of the issues that sort of crop up with the related party definition and some of the compliance things that come up for funds around that. So we're now joined by Graeme. Hi, Graeme.
Hi, Miranda.
Thanks so much for joining us on the show. So within the SMSF landscape, there are a number of different important investment restrictions that apply to transactions involving related parties. So in today's show, we're going to talk to one of the industry's true gurus about a topic that regularly appears on the ATO's radar as problematic in the industry. So firstly, Graeme, could you provide a bit of a brief recap of what the related party definition is and some of the types of entities that are actually related but often get missed by SMSF professionals or trustees?
Yeah, sure. I'll only talk about related parties because if you go into a lot of the things they're linked to, it gets quite complex. So a related party definition under the SIS legislation is limited to 3 categories, and that is to members of superannuation funds, to employer sponsors, so what we call standard employer sponsors, and then the third category is Part 8 associates. And we find the definition of Part 8 associates obviously in Part 8 of the SIS legislation.
Funny that, isn't it?
So, well, that's helpful with legislation, isn't it, Aaron? Okay, so believe it or not, sometimes the trap's a little bit more obvious than what you might think. The first one is, who's a member of a superannuation fund? Well, I can't really tell you from looking at the legislation because what it says to me is a member is a member of a superannuation fund. So that doesn't really help you at all when you read the legislation. So then you've got to go over to the trust deed of the superannuation fund, and that then tells you who is a member of that superannuation fund. So it's really up to the trust deed itself. And you might think, well, that's pretty obvious. It might be somebody that has filled in a form and they've become a trustee, a member of the superannuation fund, or they might have made a contribution to the fund and they're deemed to be a member of the superannuation fund simply because of the actions that they've taken. And maybe the trustee's got to accept the contribution or the application to that superannuation fund. Now, some traps will occur in some situations where you might have somebody who's been kicked out as a member or a director of the superannuation fund. And you might think, well, that doesn't happen. Well, I can tell you what really does happen, because in some families that are at war with each other, the kids will be members of the superannuation fund with mum and dad. And mum and dad mightn't see eye to eye with the kids, and they might boot them out of the superannuation fund. But I've got one case at the moment where the child was dismissed from the superannuation fund as a trustee and a member, and yet the employer that he works for continues to make contributions to that superannuation fund. So the question then becomes, is he still a member of that superannuation fund simply because he hasn't cancelled the contributions coming in from that employer, or because mum and dad, as trustees of the fund, have kept on accepting the contributions for that child? So that's a good question, because if it was one or two contributions, that's not a problem. But in this case, it's been going on for nearly 2.5 years. So simply by omission, you might think that that child is now a member of that superannuation fund and can be involved in the management of the fund itself. Now, there's a whole bunch of other compliance issues around that, and I'm not going to go into that.
So Graeme, it comes down to, like I said, because I think a common one as well I get asked about is, having members with a zero balance. So therefore, are they a member, or, so therefore the way in which the deed is constructed becomes critically important. So it was quite, I had a bit of a chuckle to myself when you said, well, it might be a month or two, might be fine, but here we are 2 years down the track and they're an active participant still in terms of receipt of and acceptance of those contributions. So, sure, they got dismissed, but on the basis that contributions have been accepted, do they, in essence, automatically or potentially get reinstated into that fund by virtue of those contributions then coming back in?
Yeah, I mean, you've got the trust deed itself, but then if it was ever challenged, you would think that if it ever went to the courts, you would think the courts or tribunals would look from the point of view of trust law rather than from the point of view of the trust deed itself, because if the trustees continue to blindly accept those contributions into the superannuation fund, surely that must create a right for that particular member, and he's able, or this child is able to make a claim against that superannuation fund because of what's happened. But then again, if all the parents have done is accounted for that as being an amount received for this person, they just accrue that, I don't know. I think that might be probably less likely that it would, rather than, I think the tribunals would probably accept the person as being a member of the superannuation fund in some way. Now, when you talk about zero balances, the only really good information is in a circular that APRA put out many years ago, and they've now archived that. But what in that they're saying in the sole purpose test circular that they put out was that anybody who's got a beneficial entitlement in the superannuation fund is entitled to be a member of the fund. So just because you've got a zero balance doesn't really mean that you don't have a contingent entitlement. For example, if you're a member of that superannuation fund and maybe your spouse is a member of that superannuation fund as well, and they've got an insurance policy, and you as a member, because of the spousal relationship, you might be entitled to the proceeds of that insurance policy if they happen to die or something happens to them. Then maybe you are a member. So like you say, it can really be determined by the trustee of the fund.
So the other thing, and I think you've sort of made comment on before, so we can't really delve that deep into it, but these related party rules do have multiple applications across the different investment restrictions. So, and I think one of the, so we think about related party acquisitions is one example, but I guess an interesting one that we've seen during COVID was we did see some relief in some areas around related party transactions. So maybe get you to summarise some of the areas and then the way in which the government has tackled COVID relief and what maybe we need to contemplate around those requirements as we, fingers crossed, are coming out the other side of it as well.
Okay, well, Related party definitions are interesting because you've got it for the acquisition of assets from related parties. Okay, that's section 66. You've then got it for part 8, which is about in-house assets. So whether the particular investment is in a related party. Then you've got it for division 13.3A of the regulations, which is about ungeared unit trusts and companies. And you can have an ungeared trust, which would ordinarily be an in-house asset, but you've got those exemptions with that. And the other two, which are less common, is the definition of related party for super stream purposes. And that is, if contributions are being made to the superannuation fund, then if they're made in relation to a related party, then they don't have to be registered for super stream purposes. Yep. But there's a really obscure one, and it doesn't apply to self-managed funds. It applies to the largest superannuation funds for the annual general meetings and whether certain expenses are in relation to related parties. So that came out of the Royal Commission, where there was criticism of some of these big superannuation funds spending money on directors and clients and taking them to the football and other things like that. So they're looking at that from a related party point of view as well. But that doesn't apply to self-managed funds. But it's the most obscure thing, and it's only recently been put into the legislation.
Yeah. And so talking on, the COVID bit, I just think the relief obviously was given around rent, and I guess what application that had in a related party sense, I guess that there was relief provided in the in-house asset rules. So maybe just a comment around how the in-house asset rules in that regard maybe are going to apply once, like I said, we're coming out of the pandemic now. And, well, again, fingers crossed, but the fact that the relief, we have these legislative instruments that are in play at the moment. What other things from that do people need to contemplate?
Well, I think it's mainly documentation. I was thinking about this morning. Yeah, because you've got these extensions and concessions being given by the ATO that they won't consider something as an in-house asset or a breach of the in-house asset rules is more the point of view because they haven't complied 100% with the legislation. Then I think it's having the documentation in place to show that they are on an arm's length basis or those sorts of things as well, because you're not only need to cover the in-house asset rules and the failure of the fund to meet that requirement strictly, but then you've got that leakage into non-arm's length income and things like that, and non-arm's length expenses. So there's sort of a double whammy there, I suppose, if you do breach it. But the ATO extending making an extension to comply with those rules, I think, is a reasonable thing to do.
Mm.
Just while we're on the topic of documentation and evidence, we've recently seen both regulators crack down on a lot of the issues that involve related parties, such as breaches of the in-house asset rules and arm's length requirements. What do SMSF professionals need to be really careful with when they're providing documentation or evidence or making sure they keep up with the record keeping for those kind of things?
Well, I'll tell you what the auditors really get annoyed with is no documentation at all. And you might laugh at that, but there's plenty of funds around with no documentation. And the auditor has put in an audit notice to the ATO. So they've audit contravention notice to the ATO. And then the ATO's come back and said, well, what have you got here? And the client goes, well, I don't need any documentation because it's all okay, right? Now, the ATO doesn't believe that. Now, you might think that's a strange thing. So what do you need? You need something that looks like a commercial agreement. So it needs to be as though you and I were dealing with each other. Okay, so what do we need in that documentation is really important. So it's things like the safe harbour guidelines for non-arm's length limited recourse borrowing arrangements are probably not a bad guideline. So you need something about the interest rate, the period of the loans, if you've got related party loans in there. What else do you need? The way in which it's going to be paid, it might be monthly, weekly, or whatever that might be. The relationship between the parties, how they're going to deal with disputes, because we do see that between related parties, particularly where the people who have given the loan to the super fund while they're related parties, they're not members of that superannuation fund.
Mm.
And what we often see is that some clients, new clients that come to us, you'll look through their records and they won't have paid interest for some years. And even before the COVID problem came up, they still hadn't paid interest. And they're saying to us now, well, that's okay because COVID came up and therefore that's the extension that the tax office has given us, even though the loan was taken out and they hadn't paid the interest on that loan way back in 2017 and 2018.
Yep.
So you've then got to go back and convince the ATO that they will or they have paid the interest and the repayments on that loan because, otherwise you're going to be penalised by the ATO. And we're trying to avoid that with clients, of course.
Yeah, and it's that test, isn't it, Graeme, where the related party nature, when there's strain, it's how the related parties then deal with each other under that duress. Because if it was a loan between you and me, as you said before, the way in which you would have a crack at me to try and get the money would be very different than if it was me and my own super fund or however that sort of related transaction, like you said, whether they're part of that fund or not, would naturally occur. So hence why the ATO and the legislation puts a much greater focus on the way related parties are dealing with each other to ensure that they are on an arm's length basis. Otherwise, they will look to naturally look at contraventions to the investment restrictions in place.
We've covered a lot on this topic, but were there any other sort of comments or tips that you wanted to provide, Graeme?
Well, ones that really get the auditors arced up, even though there's an agreement in place, is sometimes the rate of return that's guaranteed or allegedly guaranteed to the superannuation fund. Most of those have come out of building projects. So because of the risk associated with building, despite the fact that people don't think there's any risk in building at all, I mean, you'll see some super funds lending money to arm's length borrowers at 20 and 30%. And you think, wow, that's an amazing amount. But you're then running into some issues there with the actual, whether it's on an arm's length basis to start with. And that's what you really got to prove in the agreement, that there are other agreements around like that. That's what you're going to have to show, that are on a commercial arm's length basis.
Well, Graeme, this is a topic that you're actually talking about at this year's SMSF Association National Conference. So we know you are very insightful and very informative in your sessions with a few good jokes along the way as well. So both Miranda and I will be front and centre, looking forward to it. But once again, for the first time being a part of our podcast too, which I was surprised, but it certainly won't be the last. So thanks again.
Thank you, Aaron. Thank you, Miranda.
Thank you.
So Miranda, always insightful. He is a superannuation encyclopedia, is Graeme Colley. So related parties is a real interesting one, isn't it? Because it's kind of been around forever. It's naturally because of the nature of SMSFs in particular and the investment restrictions that are placed on them. But as we indicated, there's a few hurdles that people tend to get tripped up on. So what were some of the key takeaways you got there from Graeme?
Yeah, it was interesting, some of the traps that he sort of raised there, particularly around where there is those disputes and a member gets kicked out of the fund. That's probably something you wouldn't maybe think about, and its impact on some of those issues.
Yeah, so you're connecting the related parties and trying to understand actually, well, who is a related party of that fund or not? And so, I think that was quite fascinating. And the other thing for me, I think, is just it's that importance of documentation and making sure all the building blocks are done up front and done properly up front, because the better you proof that up front, the less you're going to have problems down the track. And that may be under audit, it may be under dispute, whatever the case may be. And I think that's where the problems start to arise, where there is, and I think Graeme spoke about this, where there's little or no evidence to try and support stuff. And that's when the ship hits the sand, so to speak.
Yeah, and I think he also raised a good point around not just relying on, because there was a bit of relief to do with COVID for things that had been going on for years beforehand. Yeah, but that documentation is really important as well.
Yeah, 2 years of relief doesn't give you relief for the 5 years that it didn't get done beforehand either.
Exactly, yeah.
So as is always the case, if you do have any other comments, suggestions on speakers or topics, Miranda, how can people get in contact with us?
So they can get in touch at editor@smsfadvisoronline.com.au. We'd love to hear any suggestions for topics or speakers.
And next time, our next SMSF Advisor Show, Miranda, do we want to give people a little sneak peek in terms of what we'll be doing?
Yeah, so we're going to be doing a big wrap of the National SMSF Association Conference, which I'm sure is going to be a very exciting event. Finally, everyone can get out in person. So, yeah, looking forward to doing a big wrap of everything that went on there.
Yeah, very much so. So thank you once again for joining us for our SMSF Advisor Show. We'll see you next time. Bye for now.